Hello and welcome to Livewire Views from the Top. My name is Chris Conway. Today I am sitting down with Qiao Ma from Munro Partners. Qiao is the lead portfolio manager for all of Munro's funds, but today we're here to talk about the Munro Global Growth Small and Mid Cap Fund. Qiao, it's lovely to see you again.
It's good seeing you again as well, Chris.
We caught up last November, and one of the things that you talked about that had surprised you from the past couple of years was the divergence of some companies away from the economy and even away from their own peers. That's when it comes to earnings, of course. Are you still seeing that in the current market environment? And what else stands out about what's happening right now?
Yeah, I mean, I say, from that conversation on, that divergence probably has become even more extreme. You go all the way from the top. NVIDIA is clearly outgrowing the overall semiconductor market. And, Meta, which is Facebook, is growing right now in the high 20% range. And that is far, far greater than online advertising. And you go all the way to the smaller end. So companies we invest in, like Shark Ninja, that makes blenders and vacuum, and is growing double digit while this end market is actually declining in the US and Europe. So we actually see the winners started to take share even more aggressively relative to both industry and definitely overall, GDP of the market.
Let's focus in on growth, Charles. I know that's where Munro lives. How have the changing macro conditions impacted the outlook? I know you guys don't focus specifically on macro, but it does impact the opportunity set. How is it impacting the way that you hunt for opportunities?
It impacted us in two ways. So if we think about growth stock and how to value a growth stock, it really comes down to two really simple elements. There is the earnings and there's the multiple. If you rewind you ran the clock back to 12 months ago, we were probably getting increasingly constructive on the earnings aspect. But we were not quite sure if great, robust earnings growth is going to be hit with a lower multiple because of the broader macro issues, especially the interest rate. We really became much more constructive when, towards the fourth quarter last year, when it was pretty obvious that, we can sit here and debate how many rate cuts we're going to get in 2024, but it's very unlikely we're going to have a rate hike. And the minute that became sort of a accepted truth for us, that really tells us that the multiples of the growth stock has bottomed. And from here on, we should go back to following earnings. And if that is actually the case, then we were really constructive on the things we own. So that's probably where it comes in the most, is the multiple going to contract for macro reasons? If the multiples are not contracting and we're right on the earnings, we really stand to make quite a bit of money here.
Qiao, just a follow-up question there, if I may. You've referenced it in both of those first two questions, the earnings growth, the sustainability of earnings growth, particularly in the US. Normally that doesn't happen, as you say, as interest rates are expected to rise or remain higher for longer. Why is it different this time? What are the elements that go into that?
Frankly, it surprised us as well. Yeah. And it took us probably a good part of 2023 scratching our heads. Usually when you start to see interest rate going from 0 to 5, you really start to see, subprime and consumer loans and interest rates and mortgages and all the way trickle down to the spending behavior consumer. But what you end up seeing is the economy just end up being really resilient. Part of it is because employment was resilient, so people end up having their jobs. And second, I'm sure a lot of people know that the fixed mortgage rate dynamic in the US, most of the people that own their homes, they really, they were locked in 10, 20 years. So they don't quite see that change in interest rates sort of directly cut into their savings and their expenses. And now, we're past the peak and short-term interest rates falling, which really sort of give us probably a good side of relief.
Qiao, many markets, global markets that is, are at record highs. Does that make you nervous at all, or is it not something that you really pay attention to?
Of course, this is something I pay attention to, and usually I would have been a lot more nervous than I am now. We were just joking about it this morning. Usually when you see market this high, as a stock picker, I tend to have my schedule freed up quite a bit because there's just not that much to buy, and everything, look around, you tend to be really expensive. But we're in a really funny period where the markets are making new highs, but it's really propelled by a handful of really, really big stocks. And it's no secret that all the major stock indexes, especially in the US, has become very concentrated. So a handful of really big stocks continue to do really well, and the market kept making new highs. But there were just a ton of companies, definitely in the mid-cap and small-cap space, but sometimes even large caps, like $100 billion companies, are actually trading quite a bit below their own historical averages, while the earnings growth is actually reaccelerating. So we are still in this really great period as a growth investor that everywhere we go, we actually see investors. We actually see lots of opportunities. So I'm incredibly busy when the market is making new highs, which is a little bit of a strange period for me personally.
I'm going to throw some numbers at you, Qiao. To April 30, the MSCI World Index added almost 19%. The MSCI World SMID Index added 11.8%. So you've talked previously about that gap narrowing between large caps and mid caps. How do you see things right now as it currently stands?
At some point, the gap has to narrow. That's just sort of how markets work. And so we, just to rewind the story back, we started the Munro Global Growth Small Mid-Cap Fund back in end of October last year. And the thesis was the gap between MSCI SMID versus MSCI World, the valuation gap is the biggest in about 20 years. So we've never seen the small mid-cap companies this cheap since the dot-com bubble bursted. So we said, well, that was really interesting. We went ahead and started a fund. And funnily, over the past 6 months, the gap actually widened further. So the SMID cap index actually fell further behind the sort of the big cap index. And look, both indexes recorded really positive returns. So we are not complaining. But the actual gap has actually widened partially because all these big cap stock has done so well and really being anointed the first wave of beneficiaries or winners for AI. So that was an interesting dynamic, but our fund itself actually did quite well because we're exposed to a lot of these thematics that propel this large cap forward as well.
Qiao, you were very modest there. The Munro Global Growth Small and Mid Cap Fund has done better than all right. It's up 29% since inception in October last year to the end of April. I know it's only a short period, but obviously nice to get off to a good start. What have been some of the drivers of that performance at a sector and thematic level?
In general, I think the performance of our fund will be quite different from the small mid-cap index. It is purposely set up to be a growth fund. So we invest in structural growth industries and structural and growing areas that we do a lot of work on as a fund at Munro Partners. And the second is it's a concentrated portfolio. I mean, this is our best 25 ideas across the team of Munro. So any particular point in time, the performance will be very, very different. And we are okay with that. And that's, basically designed that way. So we did quite well. And then the biggest drivers are probably three. One is, surprisingly, is decarbonization. So we own a number of small to mid-cap industrials companies that really enable not just decarbonize the world, but also specifically help very large industrial complexes to run in a very energy efficient way. Well, over the past 6 months, one particular industrial complex has really become very, very topical, and that's data centers. So as these very, very large scale data centers are constructed, then all of a sudden their services and expertise just become so much more valuable because obviously these large structures has to be constructed in a very energy efficient way, low emissions and all that. So that was really helpful. The second driver is high performance computing. So we end up picking 5 to 6 what we think are the best in class smaller semiconductor companies. And as the process of making semiconductors has become ever so complex, they also stand to benefit a lot because they might be small, but they actually tend to be market share leaders in just sort of very niche processes that are much needed to make these very complex AI chips. And then the lastly is actually consumer. So that actually came out as the biggest surprise. So the consumer has always been one of the top 3 areas of interest for the Munro Small Mid-Cap Fund. And when we set it up, lots of investors give us pushback and say, how could you have 5 to 6 consumer companies in your portfolio while we're all thinking the consumers are going to a recession? And it turned out our consumer companies really did well because, first of all, when we bought them, their valuations are just so low and the stocks were so cheap. And second, it turned out they just massively outgrow and outperform their own industries and gain market share and just manage really, really well throughout this process.
What has been a big driver of performance to this point so far in terms of stock names?
One of the stocks that really contributed now become one of the top 3 positions of the fund is called Wix. And this is a website builder company. And it's a pure software company, very, very high renewal rate, recurring revenue, free cash flow, very strong. So in every characteristic, it's a pure software company. During the COVID period, Wix was a massive stock market darling because we all were stuck at home. We were all selling, homemade soy candles and handicrafts and starting a website. So Wix at some point ran all the way to $300 in the stock price. And after COVID, everybody went back to work and no one wants to start a website anymore. So Wix stock price crashed all the way down to $80. And we picked up the company at sort of roughly around $120 because after we did the math, we realized since COVID, Wix has actually went from a loss-making company to now a solidly profitable company. And not only that, AI is a very good driver because now you can literally enter the text prompt and say, I want to set up a Pilates studio that has all the booking functionalities, that can take billing, that can manage my customers' database, and then AI would actually build this fully functional website all for you. And this AI is being offered by Wix. So you have earnings reacceleration, earnings growing faster, and then when we bought Wix, the stock was trading at roughly 22 times earnings. And this is the same stock that 2 years earlier investors were happy to pay 5 times sales for. So we thought, well, that was a pretty interesting opportunity. So we bought Wix, and for like 6 months, the stock did nothing. And this is very typical for small mid-cap companies. They tend to just not being discovered and priced that efficiently. And then last week, Wix came out with a really strong trading update. And then the stock basically shot up to 170 in a matter of sort of call it 10 days. So it's just one of those quite a dramatic reversal, but even at the current share price now, this is still less than 30 times earnings, growing in their free cash flow solidly in the mid-teens. Still a pretty interesting company. Another stock that did really well is a stock called Shark Ninja, and this is the half of the company is a Shark vacuum brand. The other one is the Ninja blenders. Actually, we're all pretty obsessed with the Ninja products here at Munro. At our kitchen counters, we all have one type of Ninja appliances or other. We're big on testing customer perception and making sure we all love the product, and we all do. And it was a recent IPO, so it was under a Chinese parent for quite a number of times, and then it got relisted. But this is a pure U.S. Company selling to the U.S. and European market. And then it listed in August last year. So when SMID started end of October, we did a lot of work on this company. We realized, well, this is going to be at least a 10% grower, trading at 12 times earnings and profitable with cash on the balance sheet. We just didn't quite know why it was so cheap. So we just keep buying it. And again, for a long time, nothing happened. And then it just started to report like quarter after quarter of not just a 10% beat, but like 20, 30% beat on earnings. And they just reported first quarter result and already upgrade the entire full year guidance for 2024. So that has also been a pretty strong performance contributor for the SMID. And again, like this is a 20% grower in a category that's barely growing or sometimes going backwards. So this is completely individual company specific. This is completely driven by their awesome execution.
Qiao, what about a name that you've added more recently? What's something that you've been buying?
Yeah, so it's always fun to buy these companies and knowing we might be a little bit early. So we actually bought this company called Instacart. They're not quite in Australia, but it's quite a famous company. It's in the US. It has, called 60% market share in all the online grocery delivery in the US. This is a company that back in 2021, Sequoia or a lot of the famous VCs in the US were happy to pay, roughly $30 billion US for. It became a public trading company last year. And now any public investor could buy this company at the enterprise value of roughly $8 billion. And when it had a private market valuation of $30 billion, the company was unprofitable. Now it's actually profitable. You can buy this company at 8 times EBITDA, which is sort of roughly close to free cash flow at this point, and it's still growing double digit. So it just shows, and I can literally show you like 20 of these examples in SMID where the company over the past few years have become so solidly profitable. Like on average, the profitability probably has gone up 5 to 10x from 2 to 3 years ago. Yet the actual valuation is still, call it 50, 60% off its all-time highs in 2021. And there are just examples like this everywhere in small and mid cap, and that's really what kept us pretty busy.
Qiao, I might already know the answer to this one, but I'll ask it anyway. What is the one piece of advice you would give to growth investors right now?
Literally just do the work. I think now is just one of those periods where there are a lot of opportunities if an investor is willing to look. So I think the payoff to doing the work, doing the real work in a time like this is actually really high. So yeah, I just encourage people to look beyond the thematics, the macro concerns, and actually just starting to crank away on the actual work on the companies.
The segment that we are participating in is called Views from the Top. So the question is, what is the one thing that you have learned over your journey? I know you've been in markets for quite some time now. What's that piece of advice that you could share with investors, something that you wouldn't have learned if you hadn't been in the game for as long as you've been?
And this is particularly pertinent at a time like this because there's so much debate on AI, if AI is a hype, and what to do with it. And what I've learned throughout the cycles, some of it I personally lived through, some of it I actually learned with a lot of detail through study of the history, is the market tend to really underestimate the long-term potential of a very large technology change, but it could from time to time overestimate its near-term prospect. So a lot of debate is on, well, how fast are we going to adopt AI? Well, I think we're going to adopt AI very, very fast. Has NVIDIA run too hard, or has these AI stocks run too hard? They could. I think from time to time they will. Because again, sort of overestimating the near term is sort of what the market would tend to do. But over the longer term, we're actually fairly certain the real potential of AI is being massively underestimated. And just as, when we first all got a hold of a smartphone back in 2007, nobody would know how big the smartphone could really be, how many trillion-dollar company it could really enable, or Apple was going to go up 180 times from where it was. So now the NVIDIA has gone up 4 to 5 times, and everybody say, oh, I blinked and missed it. Well, these massive technology transition, they really tend to last for a long time, and they just create this wealth that's just staggering. So that's probably the one thing that I've learned is to understand when you're at the cusp of a true transformational period and really hold on to the winner, to know that whatever numbers are that in your pack 5 years out, that's probably still too low.
Qiao, thanks so much for sitting down with Lobo.
Great to be here.
If you enjoyed that Views from the Top as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.